Hello viewers, in this video we'll be going over the S&P 500 ETF ticker symbol SPY. In this video we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for SPY. So back to the technical analysis. Today we're up 1.6% on the 1 hour chart. We were touching overbought RSI. We see a slight divergence and approaching to negative MACD. If we expand out further to the 4 hour chart, we were seeing a divergence on the 4 hour MACD. However, we converged up overnight, and we may find temporary support on the 18 moving average on the 4 hour chart. If we expand out further to the daily chart, we are currently approaching to positive MACD, and we are encountering slight resistance on the 50-day moving average, this yellow line. And we may creep a little higher. Reason why, if we use the Fibonacci retracement from the peak to where we see the lows in the dip, we see that there's a retracement of 62% or 61.8, and that coincides with a gap down between March 6th and there's a gap between March 6th and March 9th. So we may attempt to fill in that gap and possibly head lower in the meantime. At the moment, we do have that as our resistance. So that is around the price of $293.30. So for support, if we do manage to reverse from here and head down lower, the next support will be around the 9-day moving average, this blue line. We made temporary resistance, or it was previous resistance last week, and we managed to gap up overnight. So since we're above resistance, that now acts as our support, and that support is around $276.35. So if we remove this Fibonacci retracement and examine the percent movement to the resistance or the gap down, it is around 3.7% to the upside, and to reach previous support, it is around 2% to the 9-day moving average, this blue line. So let's head back to the day-by-day probability model. As the days progress to the 7th day, we have a 50% chance for S&P 500 to fall between 0 and negative 5.6% or 5.3%. And we have a 50% chance for S&P 500 to climb between 0 and 5.3%. The reason why we have a 50-50 chance is we only have 2 models to base it on. And the model that we are using is the 2008 and the 2002 models. So let's go over the day-by-day forecast for the S&P 500. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. So right here we have the current trend, and let's overlap it with the 2008 model. Not quite a good similar trend pattern we have here, but instead we have the 2002. And we did see it also move higher in the meantime. So we'll use the 2002 model as a reference. So what we have here is the current trend, and below is a trend that I believe is the best match, and that is May 28, 2002 to August 21st, 2002. So let me point out why these two charts are similar. So what we have here, we start off at the bottom Bollinger Band, proceeded to touch the upper Bollinger Band, and then we made a very large reversal to the downside, touch the bottom Bollinger Band. We see a slight resistance at the revergent mean or middle Bollinger Band, and we proceeded to break higher to touch the upper Bollinger Band. We see the similar pattern here as well. Start off at the bottom Bollinger Band, upper Bollinger Band next, and then reverse down to touch the bottom Bollinger Band, and then see the resistance at the middle Bollinger Band, and finally we proceeded to head higher at the upper Bollinger Band. So what we have here is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was May 28, 2002 to August 21st, 2002, the S&P 500 was down roughly around 4.3%. So if we head back to the day-by-day probability model, that coincides with this standard deviation of 50% between 0 and negative 5.3%. So let's examine the technical performance of each model. So we are in the current trend right here. We are down, say, 20% from monthly high, up 21% from monthly low, up 4% from 10 simple moving average, up 9% from 20 simple moving average, and down 1% from 50 simple moving average. And let's examine the trend in question that we just examined, the 2002, May 28th to August 21st. So it was down 12% from monthly high, and it was up 17% from monthly low, up 3% from 10 simple moving average, up 6% from 20 simple moving average, and up 2.6% from 50 simple moving average. The only difference we see here is the 50-day simple moving average. The trend in question was up 2.6%. Compare that with down 1% from the 50 simple moving average. So we may steadily climb higher and have the 50-day simple moving average turn positive like we saw on the 2002 model. So again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.